And now let's move to our exciting learning objective 3, that is use the contribution margin ratio. This one, to compute changes in contribution margin and net operating income resulting from changes in sale volume. So in this case, we have to find out the contribution margin ratio. So let's move further. So how we can find out the contribution margin ratio? You just divide every expenses by sales. That's it. So where this 100% came from? This came from 250,000 divided by 250,000, 100%. Where this 60% came from? 150,000 divided by 250,000. Answer is 60%. And where this 40% came from? You can easily find out sale minus variable cost. 1% minus 60% is 40%. Or this, you can find out that we know that 100,000 is our contribution margin divided by 250,000 total sales. So it's 40%. You can also find out this through per unit basis as well, right? So we know that the 500 is our sale price. So sale price, you can see the answer is 100% or 1, right? So this 60% came from, you can also find out this 300 divided by 500, and this 40 came from this 200 divided by 500. You can also find out that as well. So this slide basically find out the ratio. The CM ratio can be calculated by dividing the contribution margin per unit by the selling price per unit as well. We can also find a ratio with two methods. One is you just divided the whole figures, whole numbers. For example, here 100,000 was the CM divided by 250,000, the whole number of sales, or you can just use per unit numbers as well. So let's see how we can use the contribution margin ratio to look at the contribution margin income statement of RBC. So in a little different way. So here, if the RBC is able to increase its sales by 50,000, see, by 50,000, then it will increase its contribution by 20,000. So we can just use the contribution margin ratio approach. We know that the contribution margin is 40%, so 50,000 is increased. We just multiply it with the contribution margin, so that exactly is the same number. That is a proof here, and you don't need to make the whole contribution margin approach of the income statement. So in that way, we can also find out that, like we find out in our previous slides, through CM unit method. So we can easily find out that if the $50,000 sales has increased, it will contribute 40% to the net operating income, which is 20,000. So this is true when you see that after covering fixed cost. So you know that fixed cost is already covered. So the already amount is more than the fixed cost, right? So remember, the definition of contribution is that after covering fixed cost, whatever you sell, the contribution margin direct goes to your net operating income. So here is a quick check. So I just want to know that whether you understand this concept 100%. So just pause the video here and try to solve it by yourself, and then we're going to solve it together. So here it is. So let's read the question. That the coffee clutch is an espresso stand in a downtown office building. The average selling price of a cup of a coffee is 1.49, and the average variable expense per cup is 0.36. The average variable expenses are $1,300. So 2,100 cups are sold each month on average. So what is the CM? for coffee clutch. So we know that the CM is equal to CM multiplied by sales. So we can also find out the sales per unit or CM per unit. So we know that the CM per unit is equal to, what is the sale price? Is 1.49, and what is the variable cost is 0.36, and you just divide it by 1.49, which is your sale. So what is the answer here? 0.758, sorry, 83, or you can just choose option B. So here we can also write our profit equation with respect to, so first look at our profit equation. We developed the profit equation in our previous slides at CM per unit multiplied by units minus total fixed cost, right? So in that case, when we convert this into CM ratio, so that formula becomes CM ratio, and that is the sales in whole dollar numbers minus fixed costs. So these two are our formulas here. If you have CM per unit, that is in unit term, you can use this formula. If you have CM in ratio form, then you can use this formula. So here, if the racing bicycle increased its sales to 500, right, what would be the management expected profit or net operating income? That would be, we just put the numbers in that equation. So 40% is the CM ratio, sales to 50,000. How? 500 multiplied by 500 is the per unit cost. You can find out this 250,000 came from here. 80,000 is our fixed cost. So here is the profit, right? So I have taken exercise 6.4, page 265. So I'm just going to give you 5 minutes to pause the video and do it by yourself, and after that we're going to solve it together. Okay, let's solve it together. So let me read the question. Last month, when the Holiday Creation Incorporation sold 50,000 units, total sales were in dollar term how much? 200,000. Total variable cost or expenses 120,000, and our fixed expenses were 65,000. So what is the company's contribution margin ratio? We know that contribution margin ratio formula is CM ratio is equal to CM in units or either in whole number divided by sales in units or either in whole numbers. So we can say that CM is equal to how much? We have sales 200,000 minus the variable cost 120,000, and answer is 80,000, right? So in that case our CM ratio would be, so CM ratio would be 80,000 divided by 200,000, and that is 40%. And our second part is estimate the change in company's net operating income if the total assets increased by 1,000. We already know that, sorry, total sales increased by 1,000. We already know that CM ratio is 40%, and how much increase in sale? $1,000. So we can say that our change in net operating income would be 1000 multiplied by 40%. Answer would be $400. Right? So let's move forward.